Hi, and welcome back to Option Optics, seeing what others don't. We'll take a look at our latest trade idea, a bull put spread on Fiserv FI, soon to be FISV, as it will move to NASDAQ, as the stock absolutely got torpedoed post earnings, but finally finding a little semblance of support. So we jumped in and took advantage with a bullish put spread. We always like to use a fusion approach here, combining fundamental analysis, technical analysis, and most importantly, perhaps, implied volatility, IV analysis to help us structure the trade. So let's jump in and take a look. First of all, here is the trade signal. Came out on Thursday, right? About mid-morning. You can see Fiserv is finally finding some footing after a brutal post-earnings sell-off. Basically got cut in half as far as the stock price, the worst one-day move in Fiserv stock history. And IV, because of the magnitude of that move, remained elevated even after post-earnings. Normally you get that post-earnings vol crush. In this case, very little indeed. So let's position for some selling to start to subside, right, with an out-of-the-money bull put spread. And then I corrected. I actually put in the new symbol that it's going to change it to the correct one, which is current, buying the 55 put, selling the 60 put. So selling the 60 55 put spread that expires in November, about 3 weeks out, right, for a very nice 90-cent credit. So here we can see our approach. Here's the fundamental take. You can see on a PE basis, and certainly the other valuation metrics supported as well. You can see that the PE now approaching 11 times, right? The only time in the past 20 years it was even close to this cheap was during the height of the financial crisis. So the stock certainly getting cheap. They did come out with earnings. They did miss and guided lower, but they're still making money, right? So the company did guide to much lower sort of earnings, but they still expect for 2025 organic revenue growth of 3.5% to 4%. So it's still, they're still growing the business, right? And here's probably the most important part: an earnings per share of 8.50 to 8.60, right? I just simply put a $8 earnings per share for this year, even below the company's much lower guidance, right? And then the strike price that we're selling that 55-60 put spread, so it's 60. The PE that you would in essence be buying is only 7.5 times, right? So certainly if the stock drops to 60, or about a 10% drop from the current level, you would get in at a much cheaper level. So we certainly don't mind buying chops at a much cheaper valuation metric. As far as the technicals, we like to look at that as well. Here can you see that huge earnings gap, right? The stocks, we said, basically cut in half from 125 to the mid 60 level. You can see that RSI, 9-day RSI at the lowest level over the past 12 months by far. The last time it even came close to this was the last earnings where it missed as well. But the stock kind of leveled off. That's all we need, right? Because we got 10% downside cushion from the current price of the stock. MACD at an extreme, to say the least. Bollinger percent B hit an extreme, finally starting to strengthen here, right? And here IV, and we'll take that more closely in a second, still at the highest level of the past 12 months, even though it's off the absolute high. So the fact that we have a cheap stock, right, that still is earning money, right? See the last earnings, right? They still owned over $2 a share. So certainly not the stock that is bleeding cash here, right? But as oversold as it's been, you can buy it at a cheapest level it's been in 2 decades, right? And then from an implied volatility standpoint, simply pulled off the IV. Here's that huge run up pre-earnings, right? And then here's the pullback. We did start to see a little bit more on Friday, right? But you can see not at all like the normal vol crush. Here was that last earnings report, and IV generally at by far the highest level it's been over the past 12 months. So that means you can get further out of the money for the same net credit, get the bigger net credit for the same distance out, or kind of what we like to do, combine both, get a little bit bigger credit for a little more safety. So here you can see IV percentile still at 88th percentile, right? Even with that pullback here. So option price is still rich. You can see here's the run up. Here's the earnings date where the stock got hammered. Here you can see it start to finally bleed out. Here it was Thursday on the open. We'll take a look where we sold it, right? It was actually trading in the low 60 level. Now finally below 60. We're starting to see a little bit of that drift lower, which is normal for IV. And then seasonality of volatility. Always like to look at this as well, right? Implied volatility historically for Fiserv is the lowest in November, right? So the upcoming month, right? With a median IV, right, of just around 17. We were selling it at over 60, right? So historically, the median IV for October was around 25, right? The currently it was approaching 60 as we just took a look at here. So IV extremely high here, and November normally tends to soften. Another reason to jump into that. So here's the actual fill price, right? So here is selling two of those no 60, 55 put spreads from time and sales, getting 90 cents net credit, right? Paying 47 cents, selling $1.37 for a 90-cent net credit, right? You can see you'd be slightly long, 13 deltas net long, right? Selling a negative 22 delta, buying a negative 9, right? More importantly, there's the IV, right? In essence, selling a 62 IV, right? By selling this out of the money put spread. And you can see that that short strike price, that $60 short strike price, right? The 60.55 put spread, stock was at 66.56 when we put the trade on. Here's the actual fill. So you'd have over a 6.5 point cushion. This is after the stock had the biggest drop in its history, basically down 50%. We're able to get another 10% further up, or almost a 10% downside cushion further on selling this out of the money put spread, right? And as we talked about, we can get in at that $60 strike, right, at the lowest level we've seen as far as valuations generally. And the $60 strike certainly makes it even cheaper at 7.5 times earnings. So you can see our return on the trade. We can make 90 bucks for each spread that we sell. Our risk, it's a 5-point wide spread, right? Selling the 60 put, hedging by buying the 50 put. So we're risking $410, right? 500 less than 90 bucks we receive, right? So our return on risk, right, equates to almost 22% return on risk. Only have about 3 weeks until November 21st expiration, right? So having that kind of return in a very short time frame, right, certainly makes it even more attractive. So we can see that this trade certainly with that big 10% downside cushion, over a 20% return on a stock that has been beaten up, is getting cheap, is oversold technically, with implied volatility at the highest levels, entering into normally a seasonal kind of bearish period for IV. IV should head lower. Makes a lot of sense. And certainly it did. Took a look basically at Friday's close, right? The stock closed at 66.69. So the stock basically up a little bit, 40 cents or so from where we got into the trade, which is a benefit. You want the stock to head higher, certainly not to head appreciably lower, right? But we have that 10% cushion, so it can head somewhat lower. But with the stock at 66.69 close on Friday, you can see that 60.55 put spread already showing a little bit of profit here of 15 cents. So gaining a almost 18% of its potential profit, right? And you can see IV now under 60, so approaching that more normal vol crush here, as you can see, 58.2. So we will sell IV up here, and we should see it revert back at least somewhere towards that lower 50 level, right? If it plays out anywhere like previous sort of post earnings do. So that kind of shows how we go about identifying trade opportunities in a different way here at Option Optics, taking a look at things in a different way. So until next time, as always, here's the good trading. Take